A very good afternoon to you all, friends. I'm Sanjeev Singhal, Chairman, Auditing and Assurance Standard Board and Chairman, Sustainability Reporting Standard Board. I, on my behalf and on behalf of my Vice Chairman, CA Vishal Doshi ji, welcome you to the 63rd program of the Auditing and Assurance Standard Board for this council year on the auditing standard and audit-related matters. Friends, this year we have taken a mission to take the knowledge and learning of the auditing standard to the doorstep of every member. In this endeavor, we have done auditing standard-wise discussion in the earlier webinars. And then we started a series of doing a discussion on the item-wise elements of the financial statement. We have completed that balance sheet and profit and loss account. And today, we're discussing cash flow statement and related party. And friends, as you already know, that we are already running an expert panel series, wherein any member of our profession, if he faces any audit-related query or issue, while doing the audit of the corporate or the non-corporate sector, they can raise a question to the expert panel. And we have a panel of 50 experts, and those experts will respond within 48 hours on that particular query. And this facility is free of cost and is running up to 30th of September, because by that time, we believe that all the audits will be completed. And we started this service on 16th of April. So already from last 3 months, this service is being provided to all the members. Friends, today's topic is audit consideration in cash flow statement and related party. And we have a very young and esteemed faculty, CA Nilesh Kemka, to discuss the intricacies of the same from the auditing standard point of view, from the accounting standard point of view, from a company law perspective. So he'll give you a complete brief on what should be the audit considerations when a member or when an auditor is carrying out the audit of cash flow statement and the related party. And it's my privilege that my elder brother, CA Sanjay Agarwal ji, is the keynote speaker for today. Sanjay Agarwal ji is a very seasoned council member, and it is his fourth term in the Central Council. Previously has been elected in 2010, 13, and 16 to the Central Council, and he has served in almost all the standing and non-standing committees of the council as chairman, vice chairman, or a member. Currently, he is a chairman of the Public Relation Committee and the International Taxation Committee, a deputy convener of the Legal Directorate. And previously, of course, he has chaired, as I said, a number of committees. And I can see his contribution to the profession, the passion with which he's working on improving the brand, ICAI. And I can see the good amount of positive publicity that the institute is receiving. Sanjay Bhai has also been NIRC elected member. He has been the chairman of NIRC in 2004-05. And of course, he has served a 3-year term in the NIRC. It is indeed a pleasure to work alongside Sanjay Bhai in the council, and it's always a very enriching learning experience. He's a straightforward person, always to the point, and says what he feels within the heart. So Sanjay Bhai, thank you very much for joining our program as a keynote speaker. And I would request you to share your views on the profession or on the subject as you may feel appropriate. Thank you, and over to you, Sanjay Bhai.
Thank you, Chairman. I'm also thankful that in this niche area where I keep on learning every time, you know my forte area very well. But the way you are involving me and the last AASB meeting, where you kept on asking whether I'm here or not. So for the first time, I have attended the entire meeting. Let me tell you, we have the faculty of the day, Nilesh Bhai. So I don't think that I need to speak anything on the topic. But nevertheless, as a keynote speaker, I must say that the AASB is doing a very good job, and as it is being counted that today in this 4.5 months, you have been able to complete 63 programs. And sometime I wonder how you devote such time. Though otherwise, normally people are not devoting too much time. Even myself sometimes skip from the normal address in the webinars, etc. Uh, the topic which has been chosen is the you can say very apt topic, and audit consideration for cash flow statements and related party. So the requirement in the Companies Act, then the CARO, and then specifically various disputes which are there in the related party, whether we are required to disclose the only the transactions which we are holding, or whether we need to report whether there is no transaction or not, whether the comparative is to be given, because uh, our essay, which is 550, which is they are providing the guidelines, and then Companies Act, Section 2, subsection 76, 177, and 188. These are the various sections which are relating to all this. The cash flow sometime is very important for judging the health of an organization beside the related party. And a lot of cases when I was in disciplinary as a member, we have found in cases where the member have not disclosed the related party, and later on the allegation came on the company of siphoning of the money and circular transactions. And as such, it has gained a lot of importance in respect of disclosures as well as the true and fair view of the financials. So that is why more and more reliance are being placed uh, in respect of these two part of the audit. And as such, critically, we have to examine from the auditor's point of view, from the investor point of view, from the issued point of view. And as you know, now these days we are proactive. A lot of companies are being picked up in FRRB. A lot of informations are being sent from various regulator, by the ROC, by the police, by the SFIO, by CBI, and the later on when the cases go sore, at that time auditors are being questioned, and we cannot take them so lightly. So I hope that Nilesh will deal all these things, and I'm once again thankful to the committee and the uh, confidence with which Sanjeev Bhai has spoken about my work. So I'm not at all that you can say devoted, but yes, we work together and we progress together. And let me tell you, sometime when we go in the public, when the members at large, uh, members sometimes say that the institute is not doing the uh, what I should say that it is their due. But let me tell you, the entire council is seized of every matter. Uh, we do not publicize the things. It is not that we go and we become vocal about everything what is happening, but we take note of everything very seriously. But still, if you find that there are areas where we require some more, you can say, emphasis, more strengthening required for the profession, so you can come back to us. We are available 24 into 7. Our numbers are prominently disclosed in the website, email ID, mobile number, everything is disclosed. And even the residential telephone numbers are also disclosed. So we cannot escape, we cannot run, and we are never shy of anything that if you are criticizing. Rather, I say we should follow 3C register. First, we should get complaints as the first C. Then the second is the that your comments, and last, which we never think that we should, uh, uh, you can say that we should think that we should get, but we know that compliments are always given when we do the good job. And as such, the committee which Sanjeev Bhai is holding with the able Vice Chairman Chal Doshi ji, and I think Sanjeev Bhai, if I'm not wrong, I can say that uh, regarding the Vishal Doshi, he has become non-resident for Baroda and resident for
Absolutely.
Delhi, and he's devoting a lot of time in the board of studies, AASB, and other things. So with this, I am thankful to each one of you, especially the participants, for joining in such a large number. I've been told that before it is started, around 900 members are there, and as such continue to support us, though for the sake of interacting more, giving the best of our you can say whatever we have. This webinars mod is not being favored in the CP committee, and some fresh guidelines have been issued, but the CP hours are restricted, but learning is never is restricted at all. So thank you very much, Sanjeev Bhai and Nilesh Bhai. Uh, I'll try to remain in the whole of the your deliberation, and wherever it is required, though I may take out my photo, but I will remain over there. Thank you very much. Thanks, ma'am.
Thank you, Sanjay Bhai. Thank you so much. And now 1091 members are already live. And as you said, learning is important. So even though structured CP hours are not given, members who really want to learn, because for them, physical joining is not possible. That's why this dual mode is there. And thank you for your candid keynote address. Thank you, Sanjay Bhai. And with this, now I invite Nilesh, who's been supporting AASP in a lot of our endeavors, to kindly take the participants through this topic. Over to you, Nilesh.
Thank you, sir. Good afternoon to all the participants. I'm very thankful to Sanjeev sir and Auditing Standard Boards for giving me the opportunity to be part of this continuous learning process, which Auditing Standard Board is following for last 3 to 4 months. Today's topic, as Sanjeev sir already highlighted and Sanjay sir already highlighted, we will be having discussion on audit considerations while we audit statement of cash flows, audit considerations with respect to disclosures in related party transactions, identification of related parties, and disclosure of their transactions. Both the topics are very relevant from practical point of view in order to assess what actually is required from us as an auditor. So let us start with our discussion on audit consideration in cash flow statement. So I hope my screen is visible.
Yes, visible.
So before we start our discussion on audit considerations in statement of cash flows, let me just highlight why the cash flow is important. See, traditionally, when I started my CA or my articleship, we have been auditing, or we have been like scrutinizing the two main statements: balance sheet and profit and loss account. When our seniors used to like tell us to check the cash flow, what we used to do was just reconciling the figures with balance sheet and income statement. We were not aware of this proper presentation, what items to be categorized under cash flow from operating activities or financing or investing. But as we started our journey into the profession lately, then we understood the importance of each and every caption within all three categories, be it operating activities, be it financing, be it an investing activity. So cash flow is very important in today's scenario when we are seeing multiple mergers and acquisitions happening in the industry, takeovers are happening, right? Because cash flow statement or statement of cash flow, whatever name we call it, it provides the highlights about the solvency position of the company. Investors in today's era focuses more on the cash earning capacity or the cash flow statement rather than the balance sheet positions, because it is the historic cash flow position which provides the basis for the future projections. Cash flow statement provide us the liquidity position, the base for the short-term and long-term cash planning when the company would be requiring any sort of debt, what amount of debt will be required. It serves as the purpose for long-term investment in terms of property, plant, and equipment, whether to acquire any competitor in order to generate enough cash flows to eventually fulfill the desired level of investment. Then in terms of crisis management, management may come to know when and in what amount the loans would be required. Given the importance of cash flow, there are certain challenges also, right? Now, challenges, as we say, it is being considered or argued like it is very hard to distort or manipulate statement of cash flow. However, this is not absolutely correct. There are chances or there are ways in which a management may manipulate statement of cash flow, because if the management wants to hide any information, they may do in many number of ways. Primarily within statement of cash flows, it is the cash flow from operating activities, which is the basic earning capacity or which shows the earning potential of the company. Because investing activities are again the cash outflow where the company has invested, be it property, plant, and equipment, be in any other sort of investment activities, maybe fixed deposits, maybe investment in equity shares, maybe investment in mutual funds. When we come down to financing activities, this section shows us how the company has arranged finance or whether company has repaid the finances during the year. But cash flow from operating portion or operating activity is the section which highlights or which explains the broad movements from where the company has earned cash during the year, the items where company has spent during the year. So this is the basic earning capacity showing portion. Now, for manipulating cash flow, as I talked, there are variety of ways where management can hide the actual information. Since companies know now investors have started relying on the cash flow information to base their decision of investing or not to investing. So the focus of management is more towards showing the better picture in the cash flow from operating activities. Now, what are the ways where the relevant information can be hidden? So first and foremost could be capitalizing the operating expenses. So by capitalizing for operating expenses or shifting the operating expense from cash flow from operating activities to investing activities, so it will show better net profit. As we start our cash flow statement from net profit or profit before tax, eventually the cash flow from operating activities would improve by such amount. Second could be unsustainable activities, one-off activities. There are instances where company has exceptional gains in the profit and loss account, and the same are included in the cash flow from operating activities instead of showing that separately. Then third one could be which companies has adopted these practices in past. We will see company wise listings. So third type is like raising the debt and showing this as a part of cash flow from operating activities. Company has raised debts and these are shown as cash received from operating activities, clubbing with, let's say, trade payables or other payables. It's a presentation issue. This amount should have been shown in financing activities, but by manipulating the presentation part, the same is shown as the part of operating activities. Then there could be other scenarios which have been adopted by management in past to distort the cash flow statement in order to have the better picture of cash flow from operating activities. When we talk about audit process for cash flow statement, so I must tell you there is no set defined parameters or there is no boundary to audit the cash flow statement. What one should do or what primarily needs to be done is when we are checking cash flow statement, we need to go in nitty-gritty of each and every item. If suppose we are checking movement in the trade payables, then we should not only check the movement from the face of the balance sheet, or let's say other payables where we have 5 to 7 line items in the sub schedule. We should examine each and every line item whether the movement which is shown in the cash flow statement is reconciling to each and every item in the schedule of other payables or trade payables, or for that matter maybe other assets, current assets, non-current assets. Because what happens is a peculiar change. Up till March 31, 2021, we were showing current maturities of long-term borrowings as a part of current liabilities, current financial liabilities, right? From current year, due to changes in revised schedule 3, the same is clubbed in short-term borrowings. But what many companies has done in the last year's cash flow statement, the movement or the change in the current portion of long-term borrowings was clubbed and shown as the movement in the cash flow from operating activities. Right? So if there's a decrease or increase, it has an impact on my cash flow from operating activities. This is how the cash flow is manipulated. It does not require any sort of entries in the trial balance or any adjustments in the balance sheet. It is just the presentation issue. An item is wrongly classified or wrongly presented in either of the three sections: operating, investing, and financing. In last decade, there have been many instances like CG Power was in news in 1819. There were many instances in their cash flow statement. Then Manpasan Beverages, Indian Glycose, and there are many more. So let us start our this discussion based on what is cash flow statement. I must I think everyone would be knowing the concept, like it shows movement in and out of the money, right? It is the real earning, or I would say there is a saying, cash is real. That means the profit which is shown in the profit and loss account may not, or investors may not treat this net profit as the real earning capacity, but the cash flow from operating activities is being considered as real earning. If the net profit and cash flow from operations are not moving in line, they are moving in opposite directions, or the gap is too much, then this is an alarm that something is not correct in the cash flow statement. Ideally, the net profit and cash flow from operating activities should be moving in line with one another. So cash flow statement is divided into three parts, as we all know. From operating activities, which eventually talks about the revenue from sales, payment for purchases or operating expenses, changes in account receivables or trade receivables, changes in trade payables, other liabilities, taxes payable. Cash flow from investing activities. This section details the information about the purchase or sale of long-term investment. That may be property, plant, and equipment. That may be investment in equity shares of any other company. That may be investment in mutual funds or any other sort of investment, depending on the management's goal for the future. Then last but not the least is the financing section. It details the management's plan about the financing of the operations, from where the finances has been arranged, be it from banks, from financial institutions, from related parties. We will cover this section in our next discussion. Very important. From any other parties, or the company has raised the money through issue of shares or issue of debentures. So this section details all the financing related activities, maybe repayment of borrowings, right? Let us just see what could be the examples of each and every categories. So as I already mentioned, in case of operating activities, there could be a sale of goods, rendering of services, royalty payments or royalty receipt, any other income, commission, interest income, payments for goods or services, payments to employees or on behalf of employees, and like nature. Any cash received or any cash payment for the operating activities. Operating activities mainly covers purchase, sale, operating expenses. Cash flow from operating activities also show any repayment of loans, any new investment. When we come to investing activity portion, it mainly highlights the expenditure incurred by the company for resources which are to be used for future economic use or future cash flows. Like a company may be investing heavily into new manufacturing facility. That new manufacturing facility is a resource which will generate cash revenues in future. So examples could be acquiring fixed assets, including intangible assets, selling property, plant and equipments, acquiring equity or debt instruments like equity shares or debentures, investing in equity shares or debentures, or selling these financial instruments. When we come to the financing portion, it predicts what type of claims third party could have on the company. Now, these third parties could be the equity shareholders or the lenders, which have extended the borrowings or finances to the company. So it covers cash proceeds by issuing any shares or other equity instruments, maybe debentures, maybe preference shares. Cash by obtaining any long-term loans or short-term borrowings from banks or financial institutions or from other third parties. Payments to a lessee, where the lease period is decreased or is modified, and in turn there could be a decrease in the finance lease liability. So these are the three classifications of cash flow statement with examples of each and every type. Let us now see what are the benefits of cash flow statement, what sort of relief or advantage is there by having the cash flow statement as part of our financial statements. So basic benefit, as I already told, is it provides the base to the investors for their decision making, whether to invest in ABC or XYZ or PQR Limited. Now the question is, how can investors decide based on the cash flow statement? They can compare the cash earning capacity, i.e. the cash flow from operating activities, vis-a-vis the net profit, vis-a-vis the revenue. Better the cash flow from operating activity, better the future history for the future performance and the more attraction towards that company. Investors compare cash flow statement of various companies to arrive at their investment decisions. So needless to say, it's a key report which highlights from where the company has earned cash and where the company has spent cash during the period under review. It shows the liquidity position of the company, and again the prospects about its survival in the future. So these are some of the benefits that a cash flow statement has about the company, or from the point of view of investors for their investing decisions. This is very basic example to understand how the cash flow is calculated. So in this example, this Mr. Berry has, let's say, 10,000 in its saving account, and additionally 15,000 it borrows from a private lender, and he kicks off its business venture with 25,000 as the capital. With lots of efforts, eventually at the year end, when he is writing his books, he sees the revenue he earned during the year, or let's say profit he earned during the year, was 55,000. Now, out of this 55,000, 25,000 are its own capital, or out of 55,000, 5,000 to the tune of 5,000 is the credit sales. Now, when Mr. Berry is writing its cash position at the year end, so from the 55,000, he eventually deducts 25,000, because 25,000 was the money contributed by him from his personal wealth, and from taking out a loan from the third party lender. Remaining 30,000 is cash earned during the year. Now, out of this 30,000, amount of rupees 5,000 is not yet collected. That is a credit sale or a credit transaction. So at the year end, the surplus cash available or surplus cash received during the year is 25,000. So this is how the cash flow statement works. Whatever change is there in any account balances. Let's take an example of trade receivables. If my trade receivables are moving from 50 crores to 20 crores, that does not necessarily mean that delta of 30 crores is a cash receipt. There could be another entry which pertains to provision for debtors. So while we check, or while we prepare the cash flow statement, we need to carefully examine each and every account line item in the financial statements, because there may be a case where company has not shown the provision for debtors on the schedule level. They may have clubbed within the trade receivable amount, but that 30 crore movement does not necessarily mean a cash receipt. Likewise, there could be an entry of, let's say, we have not paid the trade payables within the credit period allowed, and accordingly, as per the agreement or contract terms, we are liable to pay interest to the vendors. And at the year end, we have created that liability and clubbed with the trade payables amount in the schedule. Now, change in trade payables amount from previous year to current year does not necessarily mean we have paid cash, right? That may mean, or the effect of interest liability is also there. The crux is, whatever line item is there in the cash flow statement, we need to deep dive into the figure to arrive at the components which make up that figure. And based on that, we will be able to come at the cash receipt or cash payment figure for that particular line item. No, we have in the starting talked about why the cash flow is important. So we have more or less covered all the points. Now just look at these points and take a read. It provides insight into the spending activities. Yes. All the three sections details where the cash has been spent and where from the cash has been received. If the company has sold certain property, plant and equipment, we will be able to correlate from the investing section. If the company has issued certain shares, we will be able to get this information from the financing section. If the company has paid or received any money from debtors or creditors, we will be able to reconcile this from the cash flow from operating sections and like any other line item. Short-term planning, and then we will be having a long-term planning as well. So this helps us, or this helps companies to know when there will be any need of cash, whether the cash requirement will be for a short-term period or for a long-term period. And accordingly, management may take decisions, or they can devise mechanism, or they can decide from where to arrange that finances. It also shows about the bankruptcy position of the company, whether the company will be able to meet its obligation, whether it be payable to vendors, payable to employees, or paying to, let's say, taxation authorities. One key change which is there in Caro 2020 is auditors are required to comment on the whether the company would be able to meet its obligations. So this cash flow statement is very important for commenting on that part, because based on the key ratios which this revised schedule 6 has specified, and based on the cash flow statement, we can build our view on the insolvency or solvency position of the company. Then it shows the cash planning results or better picture, whether the cash planning strategy of the company is in line with the company's operations and company's operating results or not, whether company is planning something else, but eventually the cash flow statement or the cash flow from operating activities is showing some other results. So they the management can correlate its future plans with the cash generating items. If the company requires more cash in future, based on the cash flow statement, they can decide on which item to focus more, on which items to rely, so that in future they will be able to meet their plans. Working capital analysis. There could be a scenario based on the cash flow statement. The employees could correlate whether the inventory levels are optimum or not, on which items they need to cut down the costs, whether excess amount is lying in the deposits with bank, or if there is a excess cash, where to deposit or where to invest. So these are some of the benefits, or I would say the important things or important benefits which cash flow statement highlights. It's just we need to carefully analyze the cash flow statement year on year. Now the interesting part, whether to manipulate cash flow statement, if how. Well, that how will be very hard to define, but we can just see some of the tactics which in past the companies has used to distort or manipulate the cash flow statement in one or the other ways. So as the first line says, it is very like considered hard to manipulate cash flow statement. However, management who want to hide the true economic picture, they can do so, and there could be a number of ways for them. So some of the techniques which I have captured in the coming slides are shifting the financial cash flows to the operating segment section, incoming to the operating section, cash outflow to the investing or financing section. Another could be shifting the operating cost to other sections that primarily to the investing sections. That is, by capitalizing the costs, we can remove the cost from the operating activities, and we can include as a part of investing sections. Using unsustainable activities or one-off activities, showing long-term loans or short-term loans as part of operating activities. Two companies in recent past, I would say, have done the sale transactions of their business or one of the verticals, and this is shown under operating activities. So let us see what has happened in this case. So this is a classic case where the operating costs has been shifted to the investing activity section. So eventually all of the expenses forms part of the cash flow from operating section, operating activities. Now what this company has done, they have capitalized these expenses as part of asset. Now, since these expenses are not in the P&L account or profit and loss statement, they are not included as in cash outflow in the operating section. The asset with which these expenses were capitalized, that asset, the purchase of asset was shown as the investing activities, and accordingly all these expenses are also get clubbed with this purchase of an asset under investing activities. So for instance, suppose there is a company which has a cumulative cash flow from operating activities 500 crores, and in the same period this company has negative free cash flow of 300 crores. This means this company is not able to generate enough cash flows from its operations to meet the capex, right? Now there may be an instance where purchase of inventory is shown as the investing activities. Suppose a company is dealing in C drives and VCDs, CDs and DVDs. Now this company regularly deals in purchase and sale of this product. So this is an inventory item for this particular company. But what this company has done, In the cash flow statement, the purchase of CDs is shown as investing activities. And eventually it gives a boost to the cash flow from operating activities. So before we audit or before we check the cash flow state, first and foremost thing is understanding the business of the company, its product, what are the products, what are the fixed assets required for the particular companies. Otherwise, we will not be able to distinguish between the inventory item and the property, plant and equipment. And this may lead to an error in the cash flow statement, like we have seen in these two transactions. If we are not capitalizing the correct amount, or if we are capitalizing the expenses which are not allowed as per Ind AS 16 or Ind AS 38, then also we are distorting the picture of cash flow statement. We are not only distorting the picture of profit and loss account or balance sheet, but the cash flow statement, because that particular amount has been shifted from the operating section to investing section. Second, which we have seen in this slide, is differentiate between the inventory items and the property, plant and equipment items. This we can be able to differentiate if we have the understanding of the entity's business, its product, its raw material, its property, plant and equipment. Second is unsustainable activities. This usually happens when companies do one-off transactions. Like most relevant is the selling of the trade receivables or securitization of trade receivables. Now, this is not a wrong practice. Companies generally do to have the cash cash flow to fix the cash flow positions. But the key here is whether the company is still liable, or it has also shifted the liability on the other party to whom these receivables are sold. Because sometimes what happens, to boost the cash flow from operating activities, companies make the transactions, but eventually the company remains liable in case the payments are not realized. So here that we need to take care while we see any sort of these transactions. Second, there could be a scenario where company does not has adequate level of inventory, and they may face a situation where they will not be able to like produce the required quantity. Why the optimal level of inventory was not kept? Maybe to show better cash positions. So these are the indicators which shows whether the company is following an optimal cash cycle or not, or whether inventory to cash conversion cycle is optimal or not. So these are the unsustainable activities which companies generally do to show their cash flow from operating activities in a better position. Now, a classic case of Delphi Corporation. What they had done is they took a loan from bank and kept the inventory as the collateral. All of the companies do that. But this company has shown that sale of inventory to the bank and loan received as the cash payment. So what has happened in this case? Sale reduced the cost of goods sold on the P&L, thereby leading to change in inventory and inflating the profit, and again giving a boost to the cash flow from operating section. So learning from this case is we need to carefully examine all the loan agreements, whether they are coming from past or whether entered during the year, whether the same accounting treatment has been followed in the cash flow statement or not. What we generally do is, okay, company has taken a loan of 100 crores coming in the balance sheet. Has they paid any transaction cost? Netted off, okay. Interest rate 15%, charge to profit and loss account, that's it. But it depends how many of us do carefully read the security clause, what the company has kept as a security or collateral, and whether appropriate charge has been created, appropriate disclosure has been made in the financial statement, and accordingly what is the treatment has been done in the cash flow statement. So till now we have seen there are various ways to distort or manipulate cash flow statement, but you will appreciate all of these cases or all of these techniques emerges from the traditional audit only. So there is no defined parameters or boundary as such for audit of cash flow statement, as I already mentioned in my first slide. Second case is the CG power. So what has happened here? The company, even before receiving the monies from the related parties, it increased its cash balance or bank balance. So one or two of the related parties of CG Power and Industrial Solution write check in the name of CG Power for the money owed, though they were not having sufficient balance in their bank account. This company received the checks, kept in the drawer. They are not presented or sent to bank, but it netted off the liability and increased the bank balance, giving the boost to its operating section. See, so here it says the promoter company and one of the subsidiary issued checks in favor of the company for settlement of the advances dues to the company in spite of having insufficient funds, though there were no funds. These checks were not presented to the bank for payment until the sufficiency of funds was confirmed by those group entities. Such checks were included as part of bank balance before being presented for payment and were inappropriately disclosed as part of balance with bank in the financial statement. So these checks were not at all sent to bank for clearance, but the company has shown in its financial statement that amount is received in the bank, and they have decreased the liability to that tune. That means my cash flow from operating activities are inflated. Second case is they have received working capital loan of 245 crores and netted off against the receivables. That means again the boost to the cash flow from operating activities, because they have shown the recoverability from the receivable to the tune of 245 crores. Again, this is also a case of receivable netting. मनपसंद beverages. In 2009, this was in news because of the resignation from the auditors. So if we see the positions, cumulative positions from FY12 to 2018, cash flow from operations is 338 crores, whereas free cash flows are 1000 crore negative. How these are calculated? Reduce this cash flow from operating from the investing section. Now, if we see in FY14, the cash flow from operations is only 2 crores, whereas the net profit is 20 crores. Again, an alarming question. Why the cash flow from operations is decreased by 90%? Again, there is a huge difference in FY17 and 18 also. 146 cash flow from operation, 73 net profits, and like in FY18. Now, in this 1339 negative, it says company has primarily used the money to buy property, plant, and equipment. And the money raised in financing was primarily from two sources: IPO for 400 crores and QIP 500 crores. We can see over here, right? Now, if we see over here, the profit before tax is 117 crores. These figures are in lakhs, but what has been considered is 100 crores. So 18 crores delta. Of the 100 crores, my cash flow generated from operating activities 37 crores. So there is a delta of 63 crores between net profit and cash flow from operating activities, out of which 18 crores is explained from here. Since company has wrongly taken the amount profit after tax instead of profit before tax, so 18 crores delta is here. Plus receivables has increased, which is depicted from the change in the revenue, right? Now, one major portion is increase in the balance with government authorities to the tune of 22 crores. Now, this needs to be examined why the company has paid so much amount with the government authorities. Is it disputed, not disputed? Because there is no mention in the financial statements for this 22 crores. Then if we see the expense in the cash flow statement, tax expense is 40. Cash flow statement, the tax expense shown is 45 lakhs here, but here we could see 37 crores. Sorry, 18 crores. So why the company has not paid the tax? Company has recorded the tax liability of 18 crores, but they have only paid 45 lakhs. Again, there is no justification or no notes for that. So while we check the cash flow statement, this is an alarming question. Why there is so much gap? Then there's an increase in employee benefits and statutory authorities. So there are various inconsistencies like short-term borrowings, 94 crores, proceeds. Here, investments are purchased. But again, these needs to be investigated. If we are auditing these financial statements, why these are not correlating with the figures in the balance sheet? Like the tax expense, here the amount is coming to 18 crores. Why the company has only shown 45 lakhs over here? There may be a case some amount is clubbed in investing or financing activity. India glycols. So if we see the positions from FY10 to FY19 over a period of 10 years, we can see the net profit for all these 10 years is 112 crores, whereas positive cash from operating activities is 2500 crores. If we see March 16, the profit was negative, but we have 1200 crores of positive cash from operating activities. Now this needs to be investigated. What has happened in March 16? If we see, long-term liabilities have increased from 4 crores to 658 crores. Trade payables have increased from 246 crores to 480 crores. Here the company has shown 909 crores as increase in trade and other payables. Now we need to see what is there in other long-term liabilities and trade payables. So if we see other long-term liabilities, the company has received advance of 654 crores from the customers, and there is a note. So this note says customers has given an advance of 726 crores to the company for supplying goods over 10 years. Now, these type of agreements are very rare, or one-off agreements where a customer has paid in advance for supply to be made over a period of 10 years. I haven't seen in my life any agreement of more than 3 years where complete advance is given. Then this is guaranteed to the customer by the SBI on behalf of India Glycols, which is again insured by Export Performance Bank Guarantee. Now, looking at the above arrangement, or as per the note which this company has disclosed in the financial statements, there is an upfront advance for goods to be supplied over 10 years. Customer, to secure himself against the risk, it has taken a bank guarantee. In case the company does not supply the goods or does not return the money, then SBI will pay that amount to the customer, and which is insured by EPBG. If we as an investor or we as an auditor see the transaction, the essence is company has taken a loan by mortgaging its asset, because when it is guaranteed by SBI, it is against the assets of the company. So it is as good as getting funds for 10 years against the assets. There could be a situation where this customer is a related party, and the enough disclosure is not given in the related party disclosures. Now, in the coming years, that contract has been modified or or changed, and the amount is refunded. So in FY16, this amount has been repaid. So these type of transactions are not what the nature is. The essence of these complete transactions which comes to the mind is it is as good as a loan, which is wrongly classified in the financial statement as other current liabilities and eventually in the statement of cash flows. So out of this 1200 crore, 650 crores is this movement. And if we did reduce this 2500, this 650 from 2500, this may come around to 1800 crores. There could be various other reasons for these type of movements. Now let's come to another, that Philatex India Limited. Here also this company has shown increase in the trades and other payables of 20 crores. When we drill down this to the current portion, we can see there is a other current liabilities movement from 23 crores to 51 crores. And when we go to this section, this is a current maturity of long-term borrowings, 29 crores or 18 crores. 18 crores. So out of this 20 crores, 18 crore or 19 crores is the movement of current maturities of long-term borrowings, which is classified or presented as cash inflow in working capital sections, which has given boost to the working capital from operating activities or cash flow from operating activities. Shri Leathers, again, they have shown the amount of 11 crores as the cash flow from current and non-current liabilities, which is eventually an unsecured loan. This should have been shown in the cash flow from financing section, but this is being shown under operating section. This unsecured loan of 11 crores. PIX Transmission Limited, what they have done is they have sold one of its divisions for 241 crores. And out of this 241 crores, the gain of 133 crores was shown over here as an exceptional item, which is shown as part of cash flow from operating activities. 134 crores. And the book value was shown under cash flow from investing activities. So again, the cash flow from operating activities is inflated to the tune of 133 crores. Albert David Limited, they have also done the same thing. They have also sold one of its division to Zydus Healthcare. And they have shown these exceptional items of 40 crores as part of cash flow from operating activities. Now, based on all these case studies and all the discussions we had done in past 1 hour, if we were to write down the audit procedures are, we need to audit the material account balances that make up the balance sheet and profit and loss account, which we do as a part of our audit. And we also do the substantive audit procedures. But once this activity is complete, the first and the foremost procedure or starting point while we do the checking of cash flow statement is we have correctly classified or presented the balance sheet and profit and loss accounts or captions in the cash flow statement. Second, we need to see if there are any non-cash transactions which needs to be adjusted had been done correctly, like the depreciation or any interest provision or any provision for doubtful debts and like nature. If there are any complex transactions which involve any non-cash item, uh, maybe complex compound financial instruments where we have some portion of equity, whether this has been correctly adjusted or not. So these are some of the checkpoints we can apply, but the most important is we need to get into the nitty-gritty of each and every account line items which forms part of my cash flow statement. Until unless we dig down to each and every line items, we will not be able to comment on the accuracy of the cash flow statement. So some peculiar items, extraordinary items, we have already talked about. Interest and dividend depends on the nature of the company. If it's a financial enterprise, that means the business is lending and borrowing, then interest and dividend should be part of operating activities. Dividend would be part of financing activities. In case of other companies, vice versa. Tax on income and gains. Generally, the income tax is part of operating activities. However, if it's a dividend tax, should go with the dividend. If it's a capital gain tax, should go with the sale of property, plant, and equipment. Non-cash transactions needs to be carefully adjusted, be it provision for tax, be it provision for employee benefits, provision for bonus, provision for expenses, provision for doubtful debts, any other non-cash items. This needs to be carefully adjusted. So that was all from cash flow statements. Let us now start the discussion on related parties. Anilji, whether we will be having questions at the last or we will be having after every topic. Anilji, are you there? So let's start our second topic, related party transactions and disclosures. What are the audit considerations? So audit of related parties. First of all, again, there is no boundary for the audit considerations in related party transactions or disclosures, because we have various financial reporting framework which casts the responsibilities or which have the requirements. And again, when any reporting framework has any requirement, we as an auditor has the responsibility or duty to ensure whether all of these considerations issued by any of the financial reporting framework whether with respect to accounting, whether with respect to disclosures, or both, have been complied with in the financial statements or not. So we have Companies Act, which governs or which provides provisions for the related party disclosures. We have Ind AS 24, which provides about the disclosures of related party transactions, related party names, related party relationships. Then for the listed entities, we have SEBI LODR, which has gone change in last year, and there are various change with respect to related parties disclosures and relationships. Apart from this, we have our standards on auditing 550 related party, which casts various responsibilities on us as an auditor. So there are various regulatory authorities which have different requirements. But if we sum up all these requirements or all these provisions, the essence is there should be adequate disclosures in the financial statements about related party transactions, related party relationships, and their names. If we disclose all the related party relationships and related party disclosures in discussion with the managements and those charged with the governance, and by following all the due diligence and audit procedures, I think we can comply with all of these requirements, be it Companies Act, be it our standards on auditing, be it Ind AS 24 requirements, and the SEBI LODR in case of listed entities. Now the question is why this related party gains so much of attention. What is the cause? The cause is, see, related parties are independent, or sorry, not independent of each other. They are being influenced by nature of their relationships. And accordingly, all the reporting framework has prescribed some sort of requirements with respect to their disclosures. So as an auditor, we need to ensure all these disclosures are complied with while we audit the financial statements. Even if one of the, let's say, reporting framework or all of the reporting framework have very less disclosures or very less disclosure requirements, in that case also we need to devise our audit procedures in such a case to obtain the understanding of all of the audit entities relationships or related party relationships based on our previous history or knowledge of the entity. We need to make sure whether all of the prospective related party relationships have been identified, and as such all the transactions with them. Needless to say, when we audit the related party relationships or disclosures, we need to be skeptical to identify if there are any undisclosed related party transactions or related party disclosures, because management may not know all the provisions, or there could be very complex related party transactions or disclosures which the management has not management has not identified, maybe due to ignorance of law or provisions, or maybe deliberately they do not want to show some of the related party transactions or disclosures. So it is very imperative from us to identify and disclose all the related party relationships. So as per the 2013 or as per the Companies Act 2013, there are various transactions like sale, purchase, supply of goods or material, selling or buying any property, leasing property, availing of rendering of services, and like. As per SEBI listing agreement, before the amendment, the related party transactions covered the transfer of resources, whether price is charged or not. After the amendment, it says related party transactions means a transaction where there is a transfer of resources, services, or obligations between a listed entity and its subsidiary on one side and related party of the listed entity or any of its subsidiary on the other side. So what it says, there is a company A and there is a related party of its subsidiary. There is any transaction, they need to disclose that. If there is any transaction between the subsidiary and its related party, A needs to also disclose that. The ambit has become very wider now. Before starting our audit, we should prepare a flow chart of all the provisions, be it Companies Act, be it India's 24, and if the company is listed, then the listing agreement provisions. We need to carefully discuss with the appropriate management in the company so that all the related party transactions and all the related party relationships are appropriately identified. Because there may be a case the company does not have effective IT system to identify all the related party relationships. So if we start timely, we will be able to corroborate all the required details to ensure proper disclosures. Standards on auditing 550. As I mentioned, it casts responsibilities on us as an auditor regarding the disclosures and relationships. Needless to say, many of the transactions with the related party are in the normal course of business. But there could be various transactions which give rise to material misstatement. For example, related parties may operate through very complex relationship and structures. Very difficult to identify whether particular relationship is within the ambit of any of the financial reporting framework and how to identify the transactions with them. Information system may not be effective to ascertain the transactions, to ascertain the outstanding balances. Third, which primarily is there in most of the companies, the transactions with the related party may not be conducted under normal market conditions or arm's length, or there may be no exchange of monetary considerations at all. Now, why audit is important? So we have seen there is an increased public interest in the quality of audits in recent years. Audit of related party transactions is very important considering the audit quality and efficiency. Currently, we as an auditor do audit of related party transactions in various different extent. Some may only audit what is required in this 24. Some may give emphasis to Companies Act also. So eventually, it is not only about whether disclosure is appropriate or not. More important is whether all the related party transactions have been identified or not. And the most important audit procedure on that is discussion, discussion, and discussion. Second is knowledge about the entity's business, knowledge about the entity's group, and the discussions. We have seen in last decade, there are various cases which have been uh, brought into the NCLT, brought into the ambit of IBC, like Bhushan Steel, Bhushan Power Steel, DHFL, and many more. ILFS case was very recent and was in news. So why all of this has happened? Because either in one or the either ways, the amount borrowed was wrongfully passed on to these sister concerns without giving appropriate disclosure in the financial statements, like Jet Airways, right? So that's why I said the cash flow statement and related parties are interrelated in a way. If there are no proper or appropriate disclosures about related party transactions in the financial statements and in the cash flow statement, this will distort the complete picture of the accuracy of the financial statement. Why all of this group failed, or why all of the frauds were perpetrated? Because there were not appropriate disclosures in either of the cases. Companies Act 13 puts significant emphasis on self-governance. Earlier in Companies Act 1956, the emphasis was more on the government approval, central government approval. Corporate governance. More responsibility and accountability on the part of board of directors, key management personals, to ensure all the related party transactions have been identified. Approval of board of directors, audit committee, shareholders in some cases is required if the company proposes to enter into the related party transactions. And there are hefty penalties also under Companies Act if there is a failure on either of the part. So if we see the approval mechanism under Companies Act 2013, it is applicable of all the companies. So audit committee approval is required in all the cases, whether the transactions are arm's length prices or not at arm's length prices. If the related party transactions are not in the ordinary course of business, or it is not at arm's length price, or both, then board approval is required. Prior consent of board is required if an entity intends to enter into any sort of related party transactions where that is not within the ordinary course, or the amount charge is not with what the companies would charge from the third parties. Shareholders approval is required in some cases based on some of the monetary limits which Companies Act has prescribed for various transactions. This is the approval mechanism for listed companies, which has been included in revised listing agreement or revised norms of related party disclosures. All related parties and their subsequent material modifications. All related parties where subsidiary of a listed entity is a party, but listed entity is not the party. That means, suppose Reliance is there. Reliance is a listed entity. Jio is its subsidiary. If Jio has any transactions with its related party, then that transaction need to be disclosed by Reliance in its standalone financial statement. Now, that particular Jio is not a listed entity, but still Reliance would need to show these transactions in the financial statement. This is covered by recent changes in the listing agreement. Now, all these transactions would require the prior approval from audit committee. If material transactions or subsequent modifications are there, then shareholders approval is required. And all these approvals are required before entering into such transactions. If these transactions are not material, then no further approval is required. Now, materiality is defined in the listing agreement, certain threshold of revenue, certain threshold of turnover or net worth. Now, based on the provisions and based on the requirements of different reporting framework, what could be the approach for audit? First of all, identification. We as an auditor need to develop the understanding of the organization, its structure and its operations, its vendors, its customers. We need to also review the current process, how the management is identifying the related party relationships and the transactions with them. And we need to identify any additional related party and transactions. Second is the pricing, whether the prices charged are at arm's length or not, how the entity is determining the pricing for the transaction with the related parties, if there are any contracts which have been entered into the past, how the prices were determined. Documentation, how whether the company has maintained any register for the related party transactions. There should be some sort of minimum documentation in case of related party transactions. There could be a mechanism of checklist, or there could be an effective IT system for verification of the supporting documents. There should be an approval mechanism to approve the transactions with related party, so that they are done at the arm length, and if not at arm length, required approval are taken before the transactions happened. There should be a checklist or a mechanism to, or a framework to capture all the transactions and relationships, so that the disclosure requirements are correct, accurate and complete. Then we need to review the IT controls in place as to the identifications of related party transactions, how the company has tagged a particular entity, how the informations are flowing in the subsidiary ledgers, so that there could be a ready reports for the disclosure purposes. There may be a modification required in the IT process. Plus, there should be a mechanism which highlights or which alarms that the approval taken, let's say company has taken approval for 100 crores of worth transaction in a year, but till July company has already done the transaction of 95 crores. So there should be a pop-up that company needs to take fresh approval from the audit committee or board or shareholder, whichever is relevant. Now, focus area for auditors. Various focus areas are there, but more significantly, there are three: identifications and of related party relationships, whether the transactions has happened at the normal course of business, or whether the prices charged are at arm length or not. Then we need to devise our mechanism in such a way that we need to opt for the substantive procedure also, where we know the management has not identified all the related party relationships, because in that case we need to ensure there is no material misstatement in the financial statement from the disclosure perspective. We can opt or we can follow 5-point action plan for the related party disclosures and transactions. It could be a planning, risk of material misstatement, internal controls, responses to risk, and the completion procedures. Planning means we need to plan the audit work in such a way that we have all the information from our previous working papers. We need to corroborate that with the discussions with the management, with the various stakeholders. We need to speak to the client's team, who is looking after the purchase and payables, who is looking after the revenue, maybe with the company secretaries, maybe legal teams, to identify the various relationships or various related party relationships. Risk of material misstatement. We need to understand the nature of the entity, its size, complexities involved in the business, information about its vendors, information about its customers. We need to understand the organizational structure from the top. What are the companies above the audit entity? What are the companies below the audit entities? We need to also scrutinize the IT returns, any shareholder registers, any legal books, or there may be various records which we can refer, like investment records, maybe board of minutes, minutes of board of meetings, minutes of audit committee, specific invoices, agreements entered during the year, bank statements, any agreements which have been changed during the year. So these are some of the techniques through which we can also identify some of the related party relationships. Internal controls, as we already covered, this is a part of IT system controls, plus the effectiveness of the client's team. The client's team should also have the appropriate level of knowledge for all these provisions. A person who is looking after the payables and purchase, if he does not have the knowledge of these provisions, he may not be able to provide his inputs on the related party relationship identifications. So it is very, very important before the start of audit, we should have the discussion with all of the persons which are involved in the balance sheet finalization or in the accounts department to have some sort of overview about the related party provisions from all of the perspective of Companies Act, India's perspective, or if the listed entity is there, then SEBI perspective, from the standards on auditing perspective. Responses to risk means we need to perform our procedure to confirm that identified related party relationships and transactions have been included in the disclosures. These can be identified by inspecting bank and legal confirmations, inspecting the minutes of shareholders meeting, any sort of board meetings or any other meetings. We can obtain the management representation letters. We can consider any fraud risk factors and accordingly devise our audit procedures on that matter. We need to see the prices charged and need to compare with the prices from the charge from the third parties. Completion procedures, again at last discuss with the all the relationships which we have identified, or the additional relationship if we have identified which management was not able to identify, then we need to discuss this with the management. And there may be a case we could identify some more relationships. Ensure that accounting and disclosures are in line with the provisions of Companies Act, Ind AS, SEBI LODR, and all the required procedures of SA 550 have been followed. These are all the points which one needs to keep in mind while we deal with the related party transactions and their disclosures. Plus we need to also see from the financial statement perspective whether we have appropriately classified the related party balances at each and every schedule level or not. If we have any receivable from related party, then we need to show that separately. If we have any payables, we need to show that separately. Any transactions in the cash flow statement should be clearly demarcated so that we have complete we have given complete disclosures in each and every aspect in the financial statements. So that was all from that related party perspective. We can have the questions.
Thank you so much, sir. Thank you so much, sir, for such a wonderful deliberation.
Thank
you
you,
have
Anilji.
justified with your deliberation. Can
See
you
the
hear me,
chat
sir?
box na, any Q&A. Anil bhai,
Yes, sir. Yes, sir. I'm just
check any question answer is there.
Yes, sir. Yes, sir. There are certain questions for Nilesh, sir. So, if you permit, can I ask, sir?
Yes, Nilesh.
Nilesh,
Sir,
sir, if you permit,
yeah,
can I
yeah,
ask the
yeah,
questions?
sir. Yes, sir. Yes, sir.
Sir, first question is, can any private limited company issue bonus debentures like bonus shares? If yes, please quote any reference under the company law or any other specific law, sir.
Sir, need to check Companies Act on this.
No issue, sir. No issue. I will take.
I will, but I will check and revert to you.
Fine, sir. Fine, sir. Sir, with reference to related party transactions, particularly those declared in the annual report of the listed companies, some of the shareholders take a tricky stand to denote such amounts shown under the related party transactions. As per statute, under equity or advances of loans or amounts, particularly when it is pertaining to overseas subsidiary companies. There are several reports cases on such form SEBI forensic audit reports as are available in the public domain websites, Google, etc. How do you relate such drastic comments as amounts siphoned off, and how do you wish to educate such tricky shareholding relating to this, sir?
So Anilji, regarding the question, this is very, very relevant, and we have also dealt with such kind of transactions and particularly disclosures. So
Yes, sir.
after Ind AS, the situation is, let's say, an entity is issuing a complex compound financial instrument to any shareholder or to any group company. Now, it is not defined whether that net amount should be disclosed, the gross amount to be disclosed, right? So the companies which wants to hide the information, they may not disclose the complete amount or the information about that financial instrument in details. So my take is, and what we advise to client is, either you report the net amount or the gross amount, but the complete details of the arrangement should be there, either as a part of related party disclosures or as part of maybe borrowing schedules or maybe advances schedules. So that complete details should be there in the financial statements, and then we should not have any comments from any regulatory authority.
Yes, sir. Yes, sir. Thank you, sir, for explaining this. Sir, as regards to the cash flow statement, some portions as investments in deposits account, particularly such amounts received from overseas, either from holding or a subsidiary companies or from the other sources, but overseas. What are the implications of such investments in deposits account in books of accounts of the
So
recipient of the company?
yes, so for the recipients, we need to again see what is the actual nature of the advances, whether they are deposits. If not, like we have seen in one of the case, the company has received the advance
Anji,
against supplies for 10 years.
Anji,
So we need to see the basics behind the transactions, whether that is only a deposit of plain vanilla nature, then it is obviously investing activities. If it is not a plain vanilla deposit, but it is against any supplies or there are any other commercials, then accordingly a disclosure has to be made in the cash flow statement.
Yes. So as you explained, there are three types of activities in the cash flow statement. One is if the company gets money on securitization of the receivables, but remains liable in case of non-payment by debtors. Will the cash inflow be shown under the financial activity?
Correct. It should be a loan.
It should be shown under the financial activity.
Financing activity, right?
So it there happened between company and outsider for purchase of goods. Later on, after 6 months, the spouse of the supplier becomes a director of the company. Spouse of the supplier becomes the director of the company. Now the question is, while preparing the financials, should the transaction which occurred before the parties were related, should be disclosed as a related party transaction?
Right, sir. It should be disclosed.
It should be disclosed as a related party transaction, whether it is before the...
Correct. Because now it is a related party.
Okay, sir. And sir, what about the joint venture of associate company can be considered as related party? Joint venture of the associate company can be considered as
joint venture of associate company is not a related party as per Ind AS 24. But again, we need to see from the Companies Act perspective. It could be a related party.
It could be a related party.
Right.
And in case of the consolidation, KMP of subsidiaries can be shown as KMP of group company.
In case of consolidation, KMP of
subsidiary companies can be shown as a KMP of group company.
Not necessarily. It should only cover the parent company.
Parent company.
Yes.
And investment in associate or joint venture, like to shown in consolidated financial or cost price or carrying value in related party disclosure.
The amount which is appearing in the financial statements or in the balance sheet, if the company has opted for cost model, then cost should be there. If the company has opted for fair value, then fair value should be there. Since it is a closing balance, so whatever is appearing in the balance sheet, that should be reported in the related party relationships or disclosures.
So one last question, a little bit big question. Let me explain. Sir, I have come across in my practice that RPTs are being raised as questions by shareholder representation up to 20% of the holdings in a listed company and refer to the ICI So question is incomplete. Not clear after that. So, it's over there only. So I will ask the member to send the question
Sure.
once again. Then I will send it to you, sir.
Sure, sir.
So these were the questions relating to today's relating to the cash flow statement as well as related party. So on behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time, and you have spared complete 1 hour and 50 minutes, 1 hour and 45 minutes. And hats off to you. You have justified with your presentation with both the topics, cash flow statement as well as the related party. We have gained a lot through your deliberation, sir, and hope our members have also gained a lot. And at present, I can tell you, sir, approximately 1600 plus members are there. Still 1600 plus members are there, and they all members have gained a lot through your deliberation. And thanks once again. Whenever we approach you, you are always available for the cause of the profession and as well as for the member. So on
Thank you,
behalf
sir,
of
for the
WSB of
wonderful
ICI,
opportunity.
I extend my heartiest thanks to you for sparing your valuable time. And once again, I extend my heartiest thanks to our Honorable Central Council member, C. Sanjay Agarwal ji, for sparing your valuable time and sparing your complete 2 hours for this today's webinar, sir. Thank you so much on behalf of WSB of ICI, sir.
Thank you,
I
sir.
enjoyed
Thank you,
it.
Sanjeev.
Rather, I learned so many things.
Yes, sir. Yes, sir.
Now
Yes,
I'm
sir.
entering into auditing field.
Thank you, sir.
Auditing.
Thank you so much, sir. Thank you so much, sir. Thank you,
Okay,
sir.
all the
Thank you.
best.
Thank you,
All
sir.
the best.
Bye.
Thank
Good
you.
day.
Thank you, sir.